Well, good evening, everybody. We actually had a whole room RSVP for tonight, so we're missing a few people. So if we have any stragglers coming in, obviously we're going to welcome them, but I want to get started. We're a little bit after 6. My name is Paul Ahern. I'm one of the partners here at the firm, and on behalf of everybody here who you're going to meet in a moment, I want to thank you for coming. Ben, are you sticking around, by the way?
I am not, actually.
Okay. Well, then I'll introduce you before you head out. Ben Wilson is one of my partners here at the firm. He helped co-found the firm in 1996. So Ben is a big integral part of what we do here, but he's heard what we're going to talk about a million times, so have a good evening. By the way, we're videotaping this tonight because we're going to post this on our website. We have a lot of clients who live out of state, and they have asked that if we're going to do events like this that they can't attend, then they want to be able to go on our website and see that. So that's why they're here tonight, so I apologize if there's any inconvenience having a microphone there and a bright light. I want to get started tonight by pointing out the fact that we hope to answer a lot of these questions. If not necessarily these questions, maybe questions in your portfolio. We recognize that our clients have a lot of concerns out there. And our hope tonight is to address some of the issues that you may be facing or that you're hearing about out there in the stock market, in the economy, etc. So tonight what I want to do is introduce you to some of my colleagues who are going to help me revisit what it is you've hired Wealth Trust to do. I want to start out on a good note. Well, and Ruth, we talked earlier about how things are improving a little bit. Many of you were at our event we did at the Biltmore in November. At that time, Greg Valiero talked about the fact that he thought that as a result of the election, as a result of the election, the Bush tax cuts would be extended for 2 more years, and that in fact has happened. So one of the things that we're going to talk about tonight is what are we doing to take advantage of that, because dividends continue to be taxed at a more favorable 15%. They were due to jump as high as 39.6% on the taxation. A statistic though I want to start out with. We're now in the 3rd year of a presidential term. And if we look back to 1945, the 3rd year of a presidential term, the stock market has averaged 17% a year. And in fact, there has never been a negative year for the stock market since the end of World War II. So will history repeat itself? Well, we don't know. But I can tell you, we just finished the month of December on an up note. It was the first time January finished up in 4 years. In fact, we had a 2.7% increase in the Dow, which was the highest jump since 1998. So that's a good piece of news to start on. Okay, so what I'd like to do tonight is to do an overview of who we are. Everybody in this room are clients of ours. You already know this, but some of you are not clients. So for your benefit, I want to introduce you to WealthTrust-Arizona. What we are is a fee-based boutique wealth management firm. And what we pride ourselves on is the fact that first and foremost, we are independent. We don't work for a brokerage firm. We don't work for a bank. We don't work for an insurance company. We are what's known as a registered investment advisory firm, RIA, which means we report directly to the SEC. What that means to our clients is that our advice is going to be much more objective. And in fact, as an independent RIA, we have what's known as a fiduciary responsibility or an obligation to our clients to always do what is in your best interest. Now you may think anybody you entrust your money to manage is going to always do that for you. But the fact of the matter is, in our industry, the brokerage profession in particular is held to a different suitability standard. It's called a product suitability standard, which means they don't have to know everything about your financial situation. They just have to know if this investment they're putting you in today is consistent with what your stated risk tolerance level and goals are for that one investment. Whereas when you meet with a firm like ours, we're going to be asking for your tax returns, copies of your wills and trusts, insurance policies, all of your account statements, etc. We need to see the whole picture because we have an obligation to advise you on multiple areas of your wealth management. And tonight we're going to talk about how we do that. The next thing I like to point out is that we are fee-based. We are not a commission-based firm. Our assets are determined by the amount of money we manage. The more money we manage, the less we bill you. And I'm going to show you what our fee schedule is in a moment. Next thing I'd like to point out is that we're plan-based. We're going to start our formal presentation tonight talking about the financial planning process. To us, that's how every relationship will begin. You're going to hear from many of my colleagues because we are team-based. You're going to hear the expertise that they bring to the table every time we meet and discuss your portfolios, as well as when you meet with them one-on-one. And finally, you're going to hear a lot from Megan tonight talk about the integration that we do here at the firm. WealthTrust-Arizona, first and foremost, is a firm that specializes in integrating financial planning with wealth management. And to help us do that, we work closely with Megan Thorns and her law partner, David Colby, who are estate attorneys. Okay, so that's a little bit about who we are. Now, as a result of all this, today WealthTrust-Arizona is one of the 10 largest independent firms in the state of Arizona. I will point out that WealthTrust, our holding company as a whole, WealthTrust, which manages about $9 billion, is one of the 15 largest firms in America on the Charles Schwab platform. And Charles Schwab is the largest independent custodian of client assets in the industry. In fact, I failed to make that point, that when you hire WealthTrust-Arizona, your assets are held at Charles Schwab or Fidelity for the most part. We're merely the hired help. If WealthTrust fell off the face of the earth tomorrow, all of your assets are at Schwab or Fidelity. So that's an important distinction to make as well. Now, here are our fees. You'll see our fees start at 1%, and then they go down depending on the level of assets that we manage. Now, I also talked earlier about the team. Here are several members of the team that are listed up here on the screen, and some of them you're going to meet here in person. But one thing I want to point out is that after each name, every advisor here has at least one advanced designation. Most people in our industry are licensed to offer securities advice. Very few people have gone on to achieve a higher level of education, which takes a lot more time. There's obviously a lot of tests to pass. But on top of that, once you have those designations after your name, you have an ethical standard to meet every year to maintain those initials after your name. So that if you ever did anything wrong to the client or something that was obviously not in their best interest, we're going to lose the ability to have those credentials. And I can tell you, we worked far too hard to earn them in the first place to ever do anything silly that would jeopardize that. Holly Deem, who many of you met, she was here earlier tonight. Holly Deem is our CEO. She runs not only WealthTrust-Arizona, but also the entire WealthTrust organization. But tonight, you're going to hear from my colleagues. And I'll start it on the left here with Megan Thorns. Megan Thorns is one of the estate attorneys. Just by a show of hands, how many people in the room have worked with Megan in the past? Okay, good. So you know Megan. Megan is going to be talking a lot about the estate planning side when we get into that. But we're going to hear a lot from Brent McQuiston tonight. Brent is a certified financial planner. He's a chartered mutual funds consultant. He worked at Charles Schwab for many years, was a senior level manager there for a number of years before we recruited him over here to work with us. Brent today is the head of our equity committee. So all the investments that pertain to the stock market, he oversees that. And you're going to hear a lot from Brent in a moment. Heath Bray, certified fund specialist. He's also a longtime employee at Charles Schwab as well before coming over to head up our alternative investments committee. One of the biggest differentiators you're going to hear from us tonight is how we allocate money to investments outside of the traditional stock and bond markets. Heath is our guy to help lead that discussion. Megan obviously is here. David Colby is not here tonight. He is our senior attorney. David has over 30 years of experience as an estate attorney. Plus, he was a Superior Court judge for a number of years as well. Megan obviously is here. David Colby is not here tonight. He is our senior attorney. David has over 30 years of experience as an estate attorney. Plus, he was a Superior Court judge for a number of years as well. Okay, so I want to get into it and talk about the 5 areas of comprehensive wealth management that we do. In the end of last year, we sent out a client satisfaction survey. And we asked our clients to respond to a series of questions with the idea that we would take their responses and improve our services. Well, one of the things that we learned is that some clients were unaware that we covered all of these core areas of wealth management. So we're going to cover 2 or 3 of them in great detail. A couple of them we will spend a little less time on. But the point is that these are all 5 core areas of wealth management that WealthTrust-Arizona specializes in. In the past, clients would come to us usually in the center of this circle, and they had a separate portfolio guy, they had a separate attorney, they had an insurance person, etc. Well, we want to try and put ourselves at the center on your behalf so that we can coordinate all of these ongoing pieces of the pie. But in the beginning, it all starts with financial planning, doing a written financial plan. And now I'd like to turn it over to Heath to talk about that.
Thank you, Paul. Thanks a lot, guys, for coming. I want to start by saying that as Paul said, we're talking specifically tonight about these 5 areas of comprehensive wealth management. And what we want to start with is what I consider to be the most important, and that is actually financial planning. We will not manage money unless it is pursuant to a written financial plan. What we do with a financial plan is we take an assessment of where your current situation is, what you're offering yourself from your portfolio as it stands. We take an inventory of your assets. We then try to get an idea of what your goals are going to be in the future. A lot of our clients, as a matter of fact, the majority of them, live off their portfolio. How much money are you going to be taking out? How much money is going to be coming in for things like pensions, Social Security, any additional savings that you're planning on doing? As we walk through that, we'll be able to take an assessment of where your portfolio is currently. We'll then take those asset classes, how your investments are currently, and try to give you an idea of what the potential return and risk is going to be for that. Then we're going to take what we would recommend that you do and compare it. We'll take an allocation that we put together that has a combination of mutual funds, separate accounts, many different investment vehicles from the equity, bond, and alternative side. We're going to talk about that at length a little later. But the importance is that we give an idea of what we're going to do, use historical data to try to give us an idea on the amount of return that we could expect from those positions, as well as any potential risk that would be associated. Now, these are going to be driven by your individual needs from a risk tolerance standpoint, from a suitability, from a time horizon standpoint. And what we'll do is we'll have this roadmap in place. And we like to call it a roadmap because the best analogy I can use for it is if you ever try to take a trip, you know where your destination is going to be, but you better have a plan on how to get there. Most of the time you're going to have to refer back to some sort of roadmap. A lot of us these days use Google or maybe a navigation center in our car. But that's what the similarity between that and our financial plan is. We know where we're going to be starting from. We know where we want to end. And we have to lay out a roadmap of how we're going to get there. Now, as we do that, what we need to talk about is the particular vehicle that's going to take us on that trip. And that is what gets into the portfolio management of what we do with, again, our comprehensive wealth management offering. And Brent McQuiston is going to talk a little bit more about the actual vehicle we use. Vehicles, excuse me.
Thank you, Heath. When we talk about portfolio management, this is something that where our team really starts to shine, because there's a lot of chaos in this world, and trying to come up with strategies that are going to be good for our clients, it's not an easy task, and so we can't work together as a team to do that. So first I'd like to talk a little bit about traditional investing. This is how most advisors and brokers in the financial business approach portfolios, is they will build a diversified portfolio of both stocks and bonds that are diversified across all different parts of around the globe, internationally and domestically, in those categories. What we have found is over the last 10 years, there have been 2 pretty horrific bear markets that we've experienced. And this approach did not necessarily fully protect the downside in a portfolio. So we think there are some better ways to look at diversifying. And so that's where we bring in alternative type of strategies as a further diversifier to the traditional model. So we're going to talk a little bit about that. Before we do that, I thought it would be helpful to understand how we make decisions as a team. Again, there's a lot going on in the world, macroeconomically, geographically around the world. There's all kinds of potential problems that can come up in a portfolio, and there's a lot to navigate through. And so we work as a team, and how we've done that is we've created a committee structure that covers various areas of the market. I happen to chair the equity committee, Paul Ahern, the fixed income committee, and Heath Bray, the alternative committee. On each committee, if you remember that picture of people on there, several of us sit on different committees, and their sole job is to come up with ideas that are going to be the best in the world, world-class ideas, to present to the portfolio committee. So each of these 3 committees report to the portfolio committee, and when a decision is made to buy or sell a particular investment, we make our case to the committee, and then the committee makes a decision whether something makes it into a portfolio or not. And in the world of investing, from an institutional advisor, there's literally over 20,000 investment vehicles that we could potentially put our clients into. So think of the committee approach as a way to take a funnel and narrow it down. And so what we're trying to narrow down is, well, first we're looking for particular strategies and managers that have a proven track record, but that can also have a repeatable track record. So just because a particular strategy may have done well doesn't necessarily predict the future. We're also looking at what type of risk a particular investment vehicle would have. So we always have a mind out for that almost before we start looking at what the potential upside is. So with all these committees working together as a team, we can narrow that scope of 20,000 plus to about 40 or so that we potentially use in client portfolios.
Hey, Brent, can I elaborate on that a little bit? We specifically recruited guys like Brent and Heath because of their teamwork mentality. We've met a lot of very successful financial planners in the Valley, but we did not feel like they could fit in this teamwork environment. They either had an ego that thought their opinions were the only ones that mattered, or they were wanting to operate in their own world and do what they thought was right for their little segment of their clients and not worry about what was best for the rest of the firm. So we specifically have sought out individuals like the people you're hearing tonight. And I personally interviewed probably 20 people over the last 2 or 3 years. And there's a lot of people in our industry looking for work. And we haven't hired anybody for 2 years now because it takes a very rare breed to fit into what we've done here. Because we're big believers that the collective wisdom of the group are going to be far better than just one individual.
And working in that team atmosphere as well, you got to have some thick skins because not everyone agrees with your opinion. and part of the process is trying to poke holes in other people's ideas. Playing the devil's advocate and seeing why a particular idea might not work. And so if it makes it through our screening process or our committee process, it's probably a pretty outstanding idea, but before it makes it to the portfolio. Doesn't mean it's going to perform great, because we never know what the future holds or what may happen. But for the most part, we've done well in that regard. Now, what I'm showing you here is a sample of what a client portfolio looks like. On the portfolio committee level, one of the things that we derive is if someone's starting out fresh with just cash and they want to invest it, how would we do that? And for a conservative investor all the way through an aggressive investor. We've defined 5 different ideal model portfolios for conservative through aggressive. This is actually model 3. And I'm showing model 3 because most of our clients fall into what we would consider a moderate risk taker. And we have 2 models that are much more aggressive than this and 2 models that are more conservative. But most of our clients fall into this. Now, it does not mean that a moderate investor at WealthTrust is going to look exactly like this, because we're doing a customized financial plan, as Heath had mentioned, that may take into account a real estate holding, such as an apartment building or a commercial office space that's held, which might fill a piece of the pie that we're looking at. There might be some inherited stocks that have sentimental value that may take a piece of this. We want to take that into account, build around it. So everything is customized, but like I said, in a perfect world, if we're starting from scratch, this is what it would look like. So what this represents here is our ideas for 2011, and specifically areas that have changed for us. We're a little more optimistic on stocks. So if you notice here, we got 50% of the portfolio, 25% in domestic stocks and 25% in international. That's an increase from where we were last year, where we're at a 40% target. And it's an increase from where we were the year before, when things were really looking bad. We're at about 30%. So we've gradually gotten a little bit more comfortable with the prospects of investments in stocks. You also notice that here on bonds, we got a 25% position there. That we've actually started to reduce. We're getting a little bit more cautious on bonds. And the reason for that is because of the risk of inflation. As interest rates go up from next to zero at the federal funds rate and climb, we will see pressure, continued pressure put on bonds. Now, if you look at the 10-year Treasury, back in October it was at about a 2.6 yield. Today it's about a 3.66. That's a pretty big jump in Treasury yields in a short period of time. So the market is kind of forecasting at this point higher rates down the road. As that happens, that puts pressure on bond prices, especially longer maturity bonds. So if you have a bond that matures in 10, 15, 20 years, it's going to be much, much more susceptible to principal decline if interest rates go higher. How we are working on to hedge that risk, first of all, is we reduced our bond exposure, and we also looked at within the bonds, what type of bonds do we want to hold? Now keep in mind, not all bonds are created equal. So if your investment in long-term treasuries, well, that has a very, very different risk profile now than having a bond that is a corporate bond that's out 1 year. And when I say where the risk is, there's definitely more risk right now we see in the treasuries because of how the prices have really run up. And the government is artificially keeping those rates low, and part of the quantitative easing program that the Federal Reserve is participating in now, they're buying up to $600 billion of U.S. Treasury bonds in the open market. What that does, it pushes the price of the bonds higher, keeps the yields low, and by doing that, they're hoping that borrowing rates stay low for a longer period of time because they've ran out of ammunition on the federal funds rate. They can't lower it anymore. So now we're in an environment where, well, if they need to stop that easing and let the bond market float on its own, we're going to see interest rates rise. And if they have to start raising interest rates. So there's multiple forces that we could see putting pressure on bonds. So how we combat that is we look at these two areas right here, floating rate bonds and short duration bonds. And what that simply means is we're looking at very, very short-term maturities. So anywhere from 6 months to a year and a half in that category of when bonds mature. When you have bonds that are maturing in a shorter term fashion, that principal can be used to reinvest at tomorrow's higher rates. So those bonds are less susceptible to decline in an inflationary environment. And then the other part I'd like to point out is foreign bonds. As the US dollar has been in a long-term decline because of excessive government spending, the value of the dollar has come down versus other currencies. And so one way that you can hedge against the value of the dollar coming down for part of your bond portfolio is to invest in bonds in currencies outside of the United States. And that's what we've done there. Paul, can you comment on Templeton?
Yeah. In fact, we had some great news. In January, Morningstar announced their 2010 Fixed Income Manager of the Year. And I'm happy to say that Dr. Michael Hassenstaub at Templeton Global Bond was given that prestigious honor. He's the guy who has been running our largest position here at the firm for a number of years now. And what's great about that is for Morningstar to lump US-based bond managers and international bond managers in the same category, there are thousands and thousands of people competing for this prize, and he was #1. So that was big news for us, and certainly affirmation that he has proven himself to be the very best in the international bond space. And that who is managing that portion of your portfolio.
On the bond side, probably the biggest questions I get is, well, what are you going to do if interest rates go up? So that's a couple of the strategies that we're employing there. On the stock side, if you notice here, it's a very, very global and diversified approach. So one of the things I'd like to point out is we have a 50% stake in international stocks with some targeted sleeves in emerging markets in Asia. It's probably the highest that we've ever been in international as well as emerging markets since we've been here. Now, we think that the emerging markets, you can't ignore it. The growth rates there in their economies are far, far ahead of where we're going to see in the developed economies around the world. Give you an example, the United States is projected to grow about 3.5% GDP growth this year. The UK and Japan and developed Europe, we're looking at approximately 1% economic growth. Pretty meager. So if that's an indication of how the markets will do in those, well, we might want to look at some other ideas. Well, emerging markets is expected to grow at about 6.5. So multiple times greater than the developed parts of the world. Doesn't mean we want to avoid the developed parts of the world. We still want to diversify, but we still want to have some targeted sleeves in the portfolio to capture that growth. As a matter of fact, 80% of the world growth is projected to come out of the emerging markets. And just to give you an idea of how powerful this trend is, by 2012, it's projected that the world's going to have about 7 billion people. And a lot of that growth is coming out of the emerging markets, countries. So those are countries like India, China, Brazil, Chile, all around the world. What we're seeing is an increase in the lifestyles of people. So you're seeing countries that had high rates of poverty are seeing increases in their middle class. As they do that, they're also buying more goods and services. Their diets are changing. They're eating more protein. It's putting more demand on grains, more demand on livestock, more demand on energy. So all these things are cycling together that we think it's important. It's going to be a volatile area. You're going to see a lot of swings up and down. But for a long-term investor, it's certainly an area that we want to participate in. On the alternative side, Heath, you got a couple comments on that?
Sure. To go back just really briefly when we were talking about the financial planning part of what we do, two of the biggest pieces of information that we were able to ascertain are an average amount of risk and an average amount of return that portfolio is going to be exposed to. When we go into alternatives, what we're talking about are things that are investments that are outside of what we consider to be traditional investments, stocks and bonds, either domestic or international. We're wanting to go out and find an area that we can invest in that will actually produce returns regardless of what happens to any of the stock or bond holdings that we already have. Now, this is not in an attempt to try to boost the return factors. What these areas do, and specifically the three areas we have on the board, and there are many more, real estate, multi-strategy, or hedge funds, which may or may not be a negative term these days, I think is a little unfair, and managed futures or commodities exposure. By adding these to your portfolio, what you're doing is you're actually taking out some of the risk percentages of that allocation on a historical basis. So we're able to get similar return rates and take sometimes a very significant level of risk reduction for that exposure to the return. And the way that we're able to do that is by using various asset classes that sometimes may seem esoteric to the non-initiated or uninitiated client. I see very few clients that come on board as new clients that have these type of investments. A lot of reason for that is, number one, advisors out there are not familiar with them. Number two, it's very difficult to get in a lot of these positions because they have tremendous minimums. We're able to bring to the table some investments that can almost, you as a retail client, invest like some of the larger endowments, because we're able to leverage, as Paul said, that very large amount of money that we have with Charles Schwab to be able to bring these offerings to you. And what that allows us to do is improve the efficiency from a return standpoint and the reduction of risk standpoint in your portfolio.
As a matter of fact, kind of talk a little bit about that. In the moderate, which is our middle of the road risk taker, it's about 25% of this target in alternatives. For a more aggressive investor, we actually have less alternatives in there. And we're going to see, for the most aggressive model, the equity piece between domestic and international stocks is going to represent about 80% of the portfolio, with a much smaller sleeve in bonds and alternatives. So that's truly a way to smooth out returns, lower portfolio risk. As you can see, there's a lot of slices of the pie around here. So this is where the committee process, working as a team, really helps us making the decisions. So we're looking at every single slice on there, finding 2 or 3 vehicles per slice on that pie to use with clients. You know, we might be using institutional-based mutual funds. We might be using exchange-traded funds that represent a particular basket of stocks in a particular market. We might, you know, for the right situation, be buying individual stocks for clients. So all these, it couldn't exist unless we had the committee approach in place, because we were able to take the collective experiences and talents from the team to help define what goes into each part of the portfolio. So now we've talked about financial planning. I've talked a little bit about portfolio management. Now, one of the things that is very important, you know, I would like to say equally as important to the management of the portfolio, is how an estate is put together. So some of the decisions made on that can literally mean hundreds of thousands of dollars to a estate if it's not done correctly, and Megan is here to make sure that that's not the case.
Thanks, Brent. One of the most unique parts about the integrated wealth management process that we have here is the integration between estate planning and financial planning. And before I get into the benefits of Arizona law, and before I talk about the benefits of integration and what integration means to our clients, I do want to talk to you a little bit about the estate tax laws that just changed last year. Towards the end of last year in December, Congress passed a 2-year law, so we're looking 2011 and 2012. There's an exemption of $5 million per U.S. citizen. So on your death, you get to pass $5 million down to your heirs free from estate taxes. That's $10 million for a married couple. And the other benefit of the law is that during the next 2 years, you can gift up to $5 million per U.S. citizen as well. So there's a great opportunity for people who are trying to transfer assets out of their estate and onto the next generation to do that during the next 2 years. And for those of you, I just want to remind, for those of you who are our clients, we've sent out letters letting you know what transpired, and letting you know as laws change, when they change, when we think they're going to change, we continue to keep you updated and let you know exactly what's going on, what we're thinking. And along that note, I do want to just point out that going forward, we know this is only a 2-year law, and I think that you're going to continue to see shorter duration laws on the estate tax level. It's not something we anticipate seeing 10 or 15-year laws or anything permanent in the next foreseeable future, at least. Okay, so now on to estate planning and some of the benefits of Arizona law. So for clients who maybe did not do their estate plan in Arizona, or who moved to Arizona after they retired, Arizona is a great place to die. It is, we are a community property state, so we are one of 9 states that allows people to hold assets as community property, and what that means is when one spouse dies, all the assets in the estate get a new basis as of the fair market value as of date of death. So it's a great opportunity for spouses who want to consolidate portfolios and maybe change their risk tolerances to be able to liquidate without worrying about any income tax consequences. In addition, Arizona does not have an estate tax. So some other states do have state estate taxes, like Washington, Oregon. Arizona does not. So that's another good reason to do estate planning in Arizona. And finally, 2009, Arizona enacted the Uniform Trust Code. And what the Uniform Trust Code said, and it did a lot of things, but one of the major benefits, at least to our clients, is that you can create a trust for the benefit of your heirs. And in that trust, you can leave your heirs as their own trustee, so they have a conversation with the mirror to pull the money out. There's no one between them and their money. But the assets in that trust are now protected from creditors, including spouses in a divorce. So that's a huge benefit if you want to leave assets to a child, but you're just concerned about the risks that they're taking in their life or the risks that their spouse is taking, and you want to just make sure you protect those assets and protect to pass them down to the grandchildren. And so that's another part of the type of estate planning that we do. We always utilize what we call generation skipping transfer tax exemptions. And what those essentially mean to you is that when we protect the assets on your estate and pass them down to your children, we're also preserving the ability to pass those assets free from estate taxes down to the grandchildren as well. So we make sure that we get the most tax advantages we can based on the limited tax advantages the government offers you. Finally, one of the most overlooked parts, I'd say, of an estate plan is IRA beneficiary designations and beneficiary designations in general. Every client who's ever come to me has said, I've got everything covered, my attorney took care of it all, I think we're good. And very rarely do I see an estate that doesn't have some issue, whether it's because tax laws have changed and maybe you could simplify things, or maybe there's benefits that you could, or at least understand and know about that have occurred since you've done your documents. But on the beneficiary designation level, that's a huge problem that we see is clients have this great estate plan, all the assets are passing to the kids, protected from creditors, whatever the case may be, however you want your estate planned, and then the IRA just passes right outside there and doesn't get any of the benefits, doesn't get any of the tax planning that we may be concerned about if we have estate tax issues. And that area of law is a more complicated area of law, and that may be why that people overlook that area. But really, in all honesty, the real reason that it gets overlooked is because when your estate planner does your estate plan, they're not working with your financial advisor, they're not integrated with your financial advisor. And so that's one of the benefits that we have here with the relationship between Colby and Thorns and Wealth Trust, is that we're all at the same table, we're sitting down, we're making sure when we do a plan that all the assets are properly titled, we're looking at the account statements, we're preparing account statements with the advisors and with their assistants to make sure that those things are done properly, the tax ID numbers are correct. And when the rubber really meets the road is when death occurs. And when death occurs, there are often sub-trusts that have to be created, new tax ID numbers, new tax returns have to be filed. And it's a complicated process, and it's something that if you don't use an integrated estate planner and financial planner, it's something where you're going to sit down with your attorney and they're going to say, okay, retitle this account this way, use this tax ID number, and file this tax return, and let me know when it's all done. And then off you go, and you walk to your financial advisor, and you walk to your CPA, and you just hope it's done right. So that is one of the benefits to having an integrated estate plan and financial plan. And a good example of that is we had one of our clients who came to see us, and her husband has just passed away. And she did not do her initial estate plan with us, but she came to us because her husband managed everything. He managed the money. He had done the trust years ago, and she really didn't know a whole lot about it. And she sat down, and she was just upset and frustrated and confused and had no clue what to do. And we were able to pull a team together with her financial advisor and sit down with a CPA and to get everything resolved and squared away. She knows exactly what's going on, but she's not responsible for doing any of it because she's hired the right advisors, and we're all sitting together taking care of it. So that is one of the benefits of integration. And on that note, I do want to let you guys know, you probably saw a flyer in your seats today, but because death occurs, and it occurs all the time, and it's unfortunately the world I live in, a lot of our clients ask, how can I be more prepared? How can I plan for death and make sure that it's easy for my spouse or it's easy for my children, or not easy, but at least that it's not complicated from the financial side and from the estate planning side. So we're having a seminar coming up. It's called Planning for the Death of a Loved One. And what we're trying to do at that seminar is give you an overview of the types of things that you, your spouse, or your children will be doing when death occurs, whether it's gathering asset valuations or creating sub-trusts, just to give you guys a better idea of what you can expect. So that seminar is coming up, and we would love to see everyone there. And if you have friends or family that you think would benefit from just hearing kind of the types of things you can expect when death occurs, we'd love to have them as well. Okay, and now we have hit estate planning, and there are two main areas left on the integrated wealth management offering that we have, and I believe Paul is going to focus on this.
Yeah, so thank you. So up until this point, everybody you've heard speak are the experts that reside right here in this office and our office in Chandler. The last 2 years, risk management and tax sensitivity, we're going to bring in outside experts and bring them to the table to help our clients, especially in the area of risk management. And here what I'm specifically talking about is insurance planning. What we have found is when we first sit down with a client, if they have existing insurance policies, they took it out several years ago, and then they never looked at it again. So they haven't revisited what it is exactly that they have, what kind of coverage is it, how good is the insurance company, are the beneficiaries still listed properly, etc. So one of the first things that we want to do when we sit down with a client is to review their existing policies to make sure that they do have adequate coverage. And to help us do that, we bring in the largest independent brokerage firm in the state of Arizona. They're called BPI, and some of you have met with them in the past. We've done workshops with them, and although all of us here are licensed to offer insurance to our clients, it's not what we do day in and day out. You can see, hopefully by now, what it is we do day in and day out, and insurance is a big piece of it, but we want somebody who's dedicated their entire profession to just solving those issues. So we bring in them. So these are some of the things that we look at. When we deal with insurance, it's usually two kinds. The first is we oftentimes are faced with an illiquid estate at the time of second death. And at the time of second death, after mom and dad have passed away, the estate taxes are due within 9 months, and the kids have inherited a lot of money, but maybe it's all in real estate, maybe it's in company stock that's privately held. There may be an illiquid asset there that they can't sell to pay the estate taxes. So we bring in the use of life insurance to help solve the estate tax liquidity issues. In addition, we also deal a lot with long-term care. Most of our clients are wealthy by normal American standards. However, the cost of long-term care can eat away at that wealth that you've accumulated your whole life growing. In fact, I think in the state of Arizona, the average cost could be anywhere from $50,000 to $70,000 per year. And it is the #1 cause of bankruptcy among Americans today. So although our clients in theory could self-insure, it's just a matter of, is that what they want to do and risk losing all that money to a nursing home or an insurance policy versus doing an insurance coverage. One of the things that I want to point out is that we just had a real-life case happen recently. We had a client who had bought a life insurance policy to settle the estate tax. They'd taken it out in 1999. Interest rates were much higher back then. The stock market was going through the roof. Insurance companies were profitable. Now, all these years later, we wanted to revisit what that contract was that the insurance company gave our clients in 1999. So we asked the insurance company to provide us what's known as an in-force ledger, which allowed us to see how much is the insurance company going to be on the hook for when the time came to pay up. And what we found is that after 11 years now of this client paying a lot of money, over $100,000 into this policy, it was due to lapse in 4 years. So the client now has the decision to make of, are they going to keep paying even more money into it longer than they planned on? Are they going to do something different with the policy? Because they had to do something, otherwise that $100,000 was going to go right down the toilet. So the ability for us to contact the insurance company and ask for this in-force illustration now allows us to bring these issues to light for our clients. Because let's face it, the world changed in 2008. A lot of insurance companies that were standing before 2008 are no longer around. Interest rates have plummeted. They're at the lowest levels that we've ever seen. So the interest rate that these insurance companies were quoting on the policies years ago no longer pertain today. So everything has changed. So it's a big part of what we do on a risk management standpoint. Finally, on the area of tax sensitivity, we don't do taxes here. What we do is help our clients minimize taxes in the way of their investment strategies and the portfolios that we develop. Heath and Brent talked a lot about exchange-traded funds. That's one of the things that we use to help minimize taxes at an equity standpoint. Municipal bonds are another thing that we use to help minimize taxes. But what we do know is that Congress has extended the Bush tax cuts for 2 more years, and then things are going to change. So in 2012, we've got to revisit this. And Dale, a CPA with one of the largest, most prominent firms here in town, is exactly the kind of person we're going to be talking to as time goes on to help us understand what does this mean to our clients. Because it is going to change, and we're going to have to plan for that. In the meantime, we want to sit down with your CPA, or at least speak to your CPA to understand your current tax situation and what we might be able to do estate planning here in Arizona. And finally, as I just mentioned, from a risk management standpoint, if you have existing policies, we'd want to review that. And if you're working with somebody, you need to ask for an in-force illustration to make sure your policies are still valid. So, in summary, this is what we do for a living, or help our clients understand what the issues are, and if they don't understand what the issues are, we want to educate them as to what they are so that we can address these types of questions. What we would ask you is if you know anybody who might also benefit from getting these questions answered, then we would hope that you would let them know about our upcoming workshops. You've got the sheet in front of you. If they want to sit down and meet with us, this is how we grow our business. We grow our business by working with happy clients. And we are always looking for more clients that may benefit from the full range of services that we offer here. Hopefully you've seen what the type of client that we don't work with. We're not here for people to make a quick buck or want to trade in and out and stuff like that. We're not that type of firm. We're long-term, comprehensive advisors here, and we would welcome any opportunity that you may have. So with that, I want to say thank you for coming here tonight. We will have more events, so please stay tuned. Our next workshop on preparing for the death of a loved one is just in 2 weeks, and then we'll have another round in March, and then there'll be more events to come in the spring and summer. So with that, I want to thank you all for coming, and have a good evening. Thank you.